For those that I have not met, my name is Philip Tremaine. I'm the Vice President of Prevention and Employer Services with the Saskatchewan Workers' Compensation Board. I'd like to welcome everyone here in attendance. It's a good crowd. And I'd also like to welcome everyone that's joining us online. We've had great participation to date in the online webinars, and I think we've got a couple hundred probably joining us today online for this session. What we're going to share with you this morning is the impact of the implementation of the enhanced rate model, which will come into effect in 2018. We made a decision not to implement the model in 2017 because, as you're going to see, the impacts of some of the changes are fairly significant, especially on certain industry sectors. Our board and administration felt it was important that we provide the opportunity for people to learn through education sessions and understand exactly how these changes might impact specific rate codes. So what we're going to show you this morning is not the 2018 premium rates. We're not going to attempt to guess that because right now we don't have all the data to determine the 2018 premium rates. What we'll show you is a comparison between the 2017 rates as currently calculated and published compared to what the rate would have been had we implemented the enhanced model in 2017. So the sessions today, the session is going to be about 2 hours, an hour of presentation and an hour for questions. And for those that, and I'll put this information up at the end of the presentation, but you'll see by the end of the presentation there's quite a bit of information, and it's quite a bit to chew on. So if you have questions after, by all means, we've got a couple different avenues, an online avenue, for you to submit your questions even after the session is done. So the agenda for today, well, we're going to start with a background about workers' compensation, how it came to exist, and a high-level overview of how premiums are set. We're going to go into the rate model review, what the impact of those changes are or would have been had we implemented in 2017, and then we'll talk about next steps. Let's get into the background. So prior to 1915, there was no workers' compensation systems in Canada. Workers seeking compensation for injuries that occurred on the job had one option: to sue their employer. Most cases were not successful. In fact, most workers didn't have the resources to even start a lawsuit. But when a worker was successful, it often meant the demise of the employer, forcing them into bankruptcy. Neither of those situations were beneficial from an economic perspective. The Ontario government of the day began to notice fairly dramatic increases in the use of their social security systems, because workers, in the absence of a work insurance program or the ability to sue the employer, were left without any way to pay for medical or earn a living. These workers ended up on social assistance programs, elevating the cost of them, so the government, recognizing this, appointed a gentleman by the name of William Meredith in 1913 to study the issue and come up with alternative solutions to the current system. Meredith came up with a notion for creating a workers' compensation system. The approach he took is often referred to as the historic compromise. The compromise meant that workers gave up their right to sue in exchange for medical and wage loss benefits, and employers assumed the cost of the system in exchange for the protection from legal action. All jurisdictions across Canada adopted the model, and each has its own workers' compensation legislation. While it's evolved over the years, the principles upon which it was designed continue to form the foundation of compensation systems today. Those 5 principles included no-fault compensation, which means workers are paid benefits regardless of how the injury occurred. The worker and employer waive the right to sue. There's no argument over responsibility or liability for an injury. Security of benefits was the second principle, which means a fund is established to guarantee that funds exist to pay for those benefits. The third principle was something called collective liability, which means that covered employers, on the whole, share the liability for workplace insurance. The total cost of the compensation system is shared by all employers. All employers contribute to a common fund. Financial liability becomes their collective responsibility. So collective liability is common to all insurance programs. And if you think about your house insurance as an example, house insurance is based on the collective experience of people with similar types of risks. Size of your house, the cost of your house, whether or not you have a fireplace, whether or not you live in a floodplain. So employers with similar types of, or people who own homes with certain types of risks get pooled, those costs get shared, and you pay premiums based on that. The fourth principle is something called independent administration, which means that organizations who administer workers' compensation insurance are separate from the government. And the fifth and final principle is something called exclusive jurisdiction, which means only workers' compensation organizations provide workers' compensation insurance. All compensation claims are directed solely to the Compensation Board, and the board is the decision maker and final authority for all claims. These 5 principles remain valid today in supporting an effective compensation system. So how do your premium rates, what's the process by which we determine an employer's premium rate? There are 3 basic steps that establish the amount of premium that an employer would pay. The first one is something called classification or industry classification. In Saskatchewan, there are roughly 47,000 employers registered with the WCB. We take those 47,000 employers and we group them into what we call rate codes based on their primary business activity. And you can think of a rate code as a risk pool. There are 50 rate codes, so 50 different industry groupings. Employers involved in similar business activity or risks are placed into that same rate code. For example, we place all employers involved in residential construction as their primary business into the B12 rate code. So all employers in the B12 rate code share in all the costs for all the claims that occur with all employers in that rate code. The same is true for other industries. Bankers are grouped together, healthcare is grouped together, etc. The premium rate is determined at the rate code level. The second step, which is a lot about what we're going to talk about today, is the process by which we would determine how much we have to collect in premiums. And we'll go through this later on in the presentation. So after the second step, we arrive at what we call a base industry premium rate. So every employer in a rate code would start off paying the same base premium rate, but recognizing that individual employers in that rate code might have different experiences. So to hold individual employers accountable for their own experience, we introduce something called experience rating, which has 2 streams. The first one is the standard program. The standard experience rating program is designed for smaller employers who pay us less than $21,000 in premiums over a 3-year period. This program is frequency-based. So it's based on the number of time loss claims that you've had. Depending on the number of time loss claims that you've had, you may be eligible for a maximum discount of 25% or a maximum surcharge of 75%. The second program is the Advanced Experience Rating Program, which is for larger employers that pay us $21,000 or more in premiums during the previous 3 years. This program is cost-based. So it's based on the cost of the claims, not the number of claims that you have. And if your individual claims experience is better than the average for your industry, you would be entitled to a maximum discount of 30%. If your injury experience is worse than the average for your industry, then you could be subjected to a surcharge of up to 200%. So to recap, employers are placed in rate codes based on their primary business activity classification. We then calculate the industry premium rate based on the collective experience of all employers in that rate code. And finally, we apply experience rating to individual employers' experience to determine the final premium rate that you would pay. Section 2, purpose of the rate model review. So why did we undertake a rate model review? The rate model review came about as a step in the review of our overall financial system. So as part of our overall review of our financial system, we began by looking at the way we invest our funds. So when we established the premium rates for 2017, what we were seeking to do was establish the premium rate that was necessary to collect today for all the costs of all the claims that would occur in 2017. Now, obviously, we don't pay all those costs in 2017. We could pay on some claims for as long as 50 years. If you have a young worker, 14, 15 years old, severely injured, our benefits end at the age 65. So it's possible for us to have costs associated with a claim that go out 50 years into the future. So we're trying to estimate the costs associated with a claim for up to 50 years. So we're trying to estimate the cost for the claims that would occur in 2017 as far out as 50 years and collect the present value for all those costs today through your premium rates. Because we're not spending all the money, we invest those premiums. And those premiums are expected to earn a certain rate of return in order to fund the future costs that have to be paid. It's kind of like a pension. So we undertook a review of our investment policy, which is the way we allocate our investment funds into various asset classes that are available, like equities, bonds, real estate mortgages, etc. And following that review, we undertook something called an asset liability study, which simply seeks to look at how closely we match the incoming of our investments with the cash flow required to pay all of our costs. So we have to achieve a certain rate of return that's assumed in the calculation of the premium rates in order to have sufficient funds to pay those costs. So part of the asset liability study was to see how closely our assets matched our liabilities. The actuary we hired was a firm called Eckler. Eckler determined that we should probably review our rate-making model because it's an integral part of our revenue generation system. Secondly, so the first major reason we did the rate review is through our actuarial review, or the review of the whole financial system. What fell out of that was a recommendation by our actuary, our external actuary, Eckler, that said you should really review how you make the premium rates, the rate model. Secondly, we were hearing from employers, particularly in recent years, that the rate model was not reactive enough to the changes that were being experienced in the industry. So it's for those two reasons the board asked us to undertake a review of the way in which premium rates are established, which is that second step in the rate model process. So it's important to understand that there are a number of principles at play in an effective rate-making model. So what we sought to do in reviewing and enhancing the rate-making model was to balance these often competing principles. So on the one hand, we want to ensure that industries are held accountable for their own injuries and cost experience. On the other hand, we want to make sure we maintain collective liability. And a part of collective liability is to ensure that employers and rate codes are not unduly burdened by extremely expensive claims. If we increase accountability of the rate code, we decrease collective liability, and vice versa. So we're really trying to balance those competing principles. On the other hand, we understand and recognize how important it is for employers to have some stability in their premium rates. So the rates are not seeing dramatic increases or decreases from one year to the next. We seek through the rate-making model to generate rates that are quite stable. But at the same time, we balance that against reactivity in the model. So if we make the model too reactive, we create volatility in your premium rates. They bounce around. If we create too much stability in the premium rates, we withhold the reactivity of the model and don't recognize current experience. So we're trying to balance these four principles that underlie the rate-making model in the most transparent way possible. So what was critical to the review process? The fundamental things that we're trying to maintain as we review the model. What we're really trying to do is indicate, as I indicated earlier, is to predict how much revenue we have to generate through the premiums in order to pay for all the costs for the upcoming year's claims. So we're anticipating that an average rate of $1.24 that we established for 2017, that money is going to be sufficient to pay for all the costs with all the claims that occur in 2017. So in conducting the review, we wanted Eckler to look at the credibility of the model from the perspective of it accurately generating the amount of premium revenue we would need to fund the system. No more, no less. We also wanted to make sure that the model was fair and equitable to all employers and that it be actuarially based, meaning that we take a scientific approach and which would remove the need to intervene in order to meet some of the outcomes that we're often looking for in maintaining fairness and equity. So what were the key findings of the Eckler review? Now, before I get into it, if you're interested in reading the actual report that Eckler provided to us, it's available on our website, as well as the asset liability study. Both of those reports are on our website and available for you to review, download or review at any time. So what Eckler actually determined is the process for determining the premium rate at the board level is sound and works well for generating the revenue requirements at the board level. I'm going to use the terms board level or board level experience a few times in this presentation. And what I'm referring to is the collective experience of all employers in all 50 rate codes within the Saskatchewan workers' compensation system. So that's the board level. So the current model works well in predicting the future costs and premiums required to fund those costs. What Eckler found, however, is that it needed some refinement because it was not doing as good a job when we got down to the individual 50 rate codes. And quite frankly, over the years, they found that as a result of some of the changes in the economy, injury prevention practices, that some of the principles like accountability and reactivity had deteriorated and required us to intervene in order to maintain things like rate stability and reduce volatility. Eckler made 7 recommendations. I'm going to talk at some level of detail about them all, except one. I'm just going to cover that off right now. And that's the second one related to classification. What Eckler noted was that in Saskatchewan, we have 50 rate codes. And some of those rate codes are very small. Some of them have less than 50 employers. Some have less than 20 employers in those rate codes. It's very difficult to predict future claims and claims costs in small rate codes. 1, 2, 3 claims and or increased costs associated with those claims can cause the experience of that rate code to bounce around like crazy. So as an example, if you were to conduct a survey and your sample size was very small, we wanted a survey of all people in this room, and I asked 2 people, would that be representative of the group in this room, their views on whatever question I asked? Probably not. So if the sample size is too small, it makes it difficult in predicting the future. It's not credible. So what Eckler noted is that we don't actually have a process to systematically review our classification system. Eckler said we ought to build that process that would require periodic reviews of the classification system with the thought that perhaps merging some of these smaller rate codes with other rate codes to create that larger sample size that would enable us to credibly predict the experience of the rate code. What the board has decided is that they would like us to build that process for reviewing the classification, but in the meantime, there are no immediate plans to review the classification system or merge any rate codes. Any process that we would build would require a fair bit of analysis and include consultation with industries that may be impacted by any change. So I just want to make it clear that the second recommendation related to classification, there are no plans to do anything in the near future about that, other than build the process to start regularly reviewing rate codes. So let's get into the impacts of the current versus enhanced model. So before I get into the details of the other elements of the rate model recommendations, I just wanted to reinforce that we are going to show you, what we're going to show you in the next few slides are the industry impacts in your rate code or rate codes had we implemented the new model for the 2017 premium rate compared to the existing model. Again, we don't know what the impact might be on the 2018 premium rates at this time because we just don't have all the claims experience, the data to predict what the 2018 rates might be. So what you're going to see is simply a proxy for the order of magnitude that you might be impacted by as a result of these enhancements to the system. The 2018 rates will be released in the fall and will include these enhancements to the rate-making model and will be updated for your current injury experience. So let's get into the first element of the rate-making model, which is credibility. So the first recommendation Eckler made was related to this concept called credibility. And it very much refers to what I was just talking about from a classification perspective. Credibility refers to the reliability to use historic experience in predicting future experience. So to the extent that you have a large enough sample size that is representative of what the future might look like, it can be reliable. But in the case of extremely small rate codes that don't have enough history or experience built up, just because they don't have enough employers or enough workers or enough injuries within that rate code, it becomes really difficult to predict if there's not enough experience in that rate code. Under the current model, what we've been doing in order to mitigate the issue is that we've been adjusting the experience of rate codes with low credibility by blending it with the board level experience. So that's that experience of all 50 rate codes combined. So what that helped to do was increase the reliability of the experience in those small rate codes. Eckler said that that's not really what we should be doing. It doesn't really hold the industry code very accountable for their own experience if we're intervening by applying the board level injury experience to each rate code or some rate codes. But Eckler recognized that you do have to have sufficient experience in order to make that prediction valid. Under the current model for all industry rate codes, we calculate the average cost of all claims paid in the last 5 years, 3 years for healthcare, medical, and 5 years for all other claims-related costs. So for the 2017 premium rates, we use the 5 most recent completed years, so 2011 to 2015. All the costs paid in each of those 5 years are added together and a 5-year average is calculated. And that 5-year average is used to predict what the 2017 experience might be. Again, under the rate model, we would calculate the average and then we would adjust it upwards or downwards depending on what the overall experience was for all 50 rate codes taken together. Eckler said that we could continue to fundamentally maintain that underlying principle. We'll use historic averages to predict future experience. However, Eckler said if the rate code was too small, you can't just limit it to 5 years experience. You should expand it to 10 years experience for those non-credible rate codes. So for an industry to be credible under Eckler's definition, a rate code should have at least $16.5 million in claims costs flowing through it over the previous 5 years. So if you have $16.5 million or more in claims costs flowing through your rate code over the previous 5 years, you would be considered 100% credible. For those rate codes that are 100% credible, it's reliable in predicting the following year's experience. However, if credibility falls below 100%, so less than $16.5 million in costs, then we would need to blend a 5 and 10-year average experience. So for example, if a rate code, let's say, had $10 million in claims costs running through it, that equates to about 60% credibility. So for that industry rate code, we'd use 60% of the average for the last 5 years and 40% of the average for the past 10 years. And that blended average is what we would use to forecast what the future costs might be in your rate code. Generally speaking, because we adjusted for all the experience with the board level experience in most rate codes. If a rate code's experience is worse than the board, and by looking at your 5 and 10-year average costs, would result in your rate increasing. So typically, if your experience has been worse than the board level, by making this change, you're probably going to see an increase in your costs. If your experience is better than the board level average, then this would have the effect of reducing your premium rate. So what happened in the B codes and R code related to this change? So for B11, again, in general, I just want to reiterate, rate codes are negatively impacted by credibility are seeing an increase because of one of two things. Their experience is worse than the board level experience. And by removing the blending, it's going to cause your premium rates to go up. But in this case, for B11, they're seeing a 6-cent decrease. Under the current model, B11 was 78% credible, or is 78% credible. B11's experience is very, very similar to the overall board level experience. For everyone online, the sign just fell that I picked up. So where was I? Credibility in B11. 78% credible under the current model. Their experience is very similar to the board level. So by moving to this, there's no real change. When we go to the enhanced model, B11 now becomes 100% credible. So we're only going to look at the 5-year costs, which and changing from the 3 to 5 year window, we're looking at medical, vocational rehabilitation, all that. The primary change is your costs related to medical and voc. Under the current model, have a 3-year look. Under the new model, it's going to be 5 years. The result of that is actually a decrease in the expected vocational rehabilitation and medical costs, causing your premium rate to go down for this element, had we implemented in 2017, 6 cents. So the real driver, and in fact this is pretty much the same in most of the B codes, the driver in terms of reductions or increases is often related to going from a 3-year look under the current model for medical and vocational rehabilitation costs to 5 years. And with medical costs typically increasing anywhere from 5 to 7% a year, when we pull in older medical costs, they're less than the newer medical costs, obviously, the most current medical costs. That causes the average to start to tip down a little bit. That's really the impact of really what's happening in these rate codes. B12 is very similar. Under the current model, 87% credible. The experience, again, is very similar to the board level. Under the enhanced, the new model, it's going to be 100% credible. And the driver of this change, again, is simply looking at medical costs over 5 years versus 3 years. B13, 90% credible. Their experience has typically been better than the overall board experience, which is causing a bit of a decrease. And obviously, moving to the new model, they're going to be 100% credible. And again, that 3 to 5 year window, that change of looking at medical costs over 5 years versus 3 years, the combination of those two things would see a decrease in this element of the rate code by 5 cents. R11 is a little different when it comes to this particular element of the rate code. Under the current model, R11 is 84% credible. However, their experience is worse than the overall board experience. So removing the blending causes their costs to go up. Under the enhanced model, they're 100% credible. So you're going to look at the 5-year costs. So when you, which pretty much was a no change. So the new model doesn't really impact them at all, but the increase is just simply removing the existing model. Because R11's experience has typically been worse than the board level, when you remove the board level experience from the current model in R11, it's driving up this element of the premium rate by 5 cents. What you'll find as we go through these presentations, and I think this is the 3rd or 4th one I've did, just about in every rate code you're going to see numbers go up and down in different areas for different reasons. So I think there's only 1 or 2 that I've seen every bar go down or every bar go up. Use of the indicators to predict costs. The next recommendation that Eckler made was to do with the use of indicators in predicting future costs. So I already just told you that we use a 5-year average to calculate what we expect in terms of spending in the future. As part of determining future costs in the existing model, we try to forecast the number of time loss claims. We then attach an average cost per claim to the forecast of claims in order to determine the future revenue requirements. So how many claims do we think you're going to have based on trends? What's the average cost of those claims? Come up with an estimation in terms of future revenue requirements that we would need to cover those costs. The problem with that is in recent years we've seen significant decreases in both the time loss and total injury rates and significant decreases in the number of claims. However, the costs of claims have not seen a corresponding decrease. In fact, in some cases we see increases. So using time loss claim counts as an indicator of the way costs might move is no longer valid. In the 1990s, when this indicator came about, there was a high correlation between time loss claims and costs. Over the last few years, that correlation doesn't really exist. Claims are on a steady decline while costs have been on a steady increase. What Eckler said is that you need to stop using the number of time loss claims as an indicator of what future costs might be. Eckler suggested we stick to a 5 and 10-year average and then simply adjust that average by the change in the workforce. The change in the workforce simply means the percentage change in the number of workers covered in a particular industry code. So when we graph the change in costs with the change in workforce, we have a very strong correlation. It's almost 100%, I think 97%. The change in workforce maps almost 100% to the change in costs. It validated what Eckler was saying, that the movement of costs has a high correlation in the movement in the change of workforce. In recent years, the correlation between costs and time loss claims was actually negative. I think it was a negative 88% correlation, where a change in workforce is a positive 97% correlation. And so we accepted the recommendation, and we will no longer use time loss claims to predict future costs. We will rely on the change in workforce to adjust that 5 or 5 and 10-year average of costs. So if we see a 5% growth in your workforce, we will assume the average costs of claims will grow by 5%. Because of the volatility in some of the premium rates, we were blending the current year's premium rate with the previous year's premium rate, basically averaging the two. So for whatever the model would spit out for 2017, we would have an average we would have averaged the 2016 premium rate with whatever we charged you in 2017. So if we were using time loss claims, which we are, using time loss claims to predict costs, and that correlation is not strong, we were not predicting, by using time loss claims as a predictor of costs, we just weren't predicting the amount of costs accurately. The blending of the previous year's premium rate and current year's premium rate was just simply designed to make sure two things. We're bringing in enough premium to cover the costs, but also not allowing for premium rates to bounce around significantly. Because in some cases, and I've seen this in a few rate codes, a few claims, a couple of costly claims could cause some premium rates and rate codes to jump up dramatically. And we'll get into predicting future claims, and claims costs a little bit more. But the bouncing around, had we not blended, some of the premium rates would have bounced around significantly from one year to the next. And we were not necessarily accurately predicting the costs associated with those claims. So there's two major factors at play here in terms of this particular element of the premium rate. So had we implemented this change in 2017, B11 would have seen an 11-cent increase for this element. So under the enhanced model, time loss claim counts have been decreasing significantly in B11 since 2009, which means that the time loss claims caused by the rate model caused the rate model to expect a corresponding decrease in claims liabilities. So we were seeing significant decreases since 2009 in claims. The current model would have suggested we were going to see a corresponding decrease in costs. Meanwhile, the liability of claims, the cost of claims, have actually been increasing. So this was not being recognized in the current model. Using workforce will cause the rate code to expect an increase in liabilities, which is more in line with the growth of the industry over the last few years. Therefore, the adoption of workforce as an indicator of costs will increase B11's premium rate by 18 cents. By removing the current model, which was in order to promote kind of that stability in the premium rate and the kind of the large swings in time loss claim counts, the initial premium rate was averaged with the previous year's premium rate. By removing that averaging, would see a decrease of 7 cents. So the combination of those two things, we'd get an 11-cent increase in this element of the rate code. The rate model, sorry. B11, a very similar story. Significant decreases in time loss claims over the last few years. So the model was predicting lower than expected costs. By moving to workforce, we're going to see an actual increase in the prediction of costs based on that. The increase is actually going to lead to a 35-cent increase in this area of the premium rate. But when we pull out the blending of the previous year's premium rate and the current year's premium rate, that would cause the premium rate to drop by 21 cents. The combination of those two elements are seeing an increase of 14 cents in this element of the premium rate. So by going to the new model causes it to go up. Removing the current model causes it to go down. The combined effect of that is up 14 cents. B13, again similar. Dramatic decreases since 2011 in time loss claims. This caused the model, obviously, to not predict enough in terms of time loss claims costs. There has been significant increases in claims liabilities and significant increases in the number of people working in this industry over the last few years. Therefore, the adoption of workforce as an indicator of cost would actually see B13 go up by 45 cents. But by removing the current model, which is the blending of the previous year's premium rate and current year's premium rate, would cause a decrease of 18 cents. The combined effect of those two changes is a 27-cent increase in this area of the premium rate. So really holding industries more accountable for their own experience. In R11, a little different. Between 2013 and 2015, time loss claim counts have been steadily decreasing. The use of the workforce indicator would cause the rate model to expect an increase in claims liability. However, in 2014-2015, the industry itself shrank a bit. So the number of workers working in the industry went down, and therefore there would be a similar type of recognition in the model now. As the workforce goes down, there's an expected decrease in costs. The combination of those two things happening in the enhanced model would see an increase of 3 cents in the premium rate. However, removing the current practice of the current model, which is blending the previous year's premium rate with the current year's premium rate, would see a decrease of 11 cents. So the combined effect of those two changes would see an 8-cent decrease in this element of the premium rate had we implemented it in 2017. So those are the impacts of going from changing the indicator from time loss claims to workforce. The next recommendation that Eckler made and that the board accepted relates to costly claims pooling. So I said earlier, collective liability has two basic elements to it. First, we are collectively responsible for all the liability associated with the injuries that occur in your industry rate code. The second element is that employers should not be unduly burdened by excessively expensive claims. Under the current model, we have a claims cost capping that is limited to pension costs only. When we talk about pension costs in the compensation system, or at WCB in Saskatchewan, these are long-term claims that have some form of permanent loss of earnings. And often those earnings will continue, that wage loss will continue until about the age of 65. So it's really an earnings replacement. It's not pension in the way we typically think of pension. It's long-term earnings replacement. Under the current model, if the cost of pensions related to an individual claim in a rate code exceeds $90,000, we cap those costs at $90,000, and the difference between the $90,000 and what the actual cost for that pension would get spread across all employers in the class. So the class is, for example, the B code. All rate codes that start with B are in the B class. And for the R code, they are their class. There's one rate code, and so you'd cap a pension at $90,000. Whenever that pension hit $90,000, all additional costs would get spread across all employers in that class. So, for example, if an employer in B13 had a claim with a pension related costs of $150,000, we would cap the cost at $90,000, and the other $60,000 would be distributed to all rate codes in the B class. Proportionately, and that amount would get spread proportionally based on the amount of payroll. The amount of payroll in each rate code. So collectively, we share in that capping. All employers share at the class level based on the cap of that pension claim. Eckler said claims cost capping is a necessary part of the rate-making model. However, he said, the way we're approaching it isn't quite right. First of all, the $90,000 is a fixed amount and has been in place for a number of years. It hasn't been indexed to anything. Eckler said that if you're going to have a claim cap, it should somehow have an indexing provision to it. So as things change moving forward, the claims cost cap would escalate with it. Secondly, he said, it doesn't make any sense that you apply only that methodology to only pension costs. It should apply to all compensation-related costs. Eckler recommended that we establish a multiple of the maximum insurable earnings to determine what that claims cost cap should be. So what the board has approved is that we would use 3 times the ultimate maximum insurable earnings, which equates to just under $252,000. That would apply to all claims costs, not just pensions. The second part of that decision by the board, that the difference between the claims cap, approximately $252,000, and the actual costs of the claim would be spread across all rate codes at the board level based on your claims costs, not your payroll. So now we have spread the collective liability beyond the class to every rate code in the system. If you had a claim for $400,000, you'll be responsible for the first $252,000, and the other $148,000 would be spread proportionately across all 50 rate codes based on claims costs. So let's take a look at how this change would impact the various construction rate codes. So for B11, we'd be seeing a 5-cent decrease had we implemented in 2017, a 5-cent decrease in this element of the rate model. So average pension costs were lower than the average B class pension costs. So the pension pooling used to increase your premium rate. However, costs in excess of 3 times the maximum are much higher than the board average. So therefore, pooling costly claims is going to have the impact of decreasing your premium rate. The combined effect of those two changes is a 5-cent decrease in this element of the B11 rate code. For B12, there's really no net effect by making this change. Average pension costs are higher than the average B sector costs. So B12 used to benefit from the pension pooling. B12 used to benefit from the pension pooling. Costs in excess of 3 times the maximum is higher than the board average, so which would cause a decrease in your rate. So those two forces kind of balance each other out in this case, resulting in no net change by changing the way we pool costly claims. B13 would see a 14-cent decrease based on this change. The average pension costs are pretty much equal to the average B class, so there was no net effect of changing the way we deal with pension costs or pension pooling. However, B13 costs, so their claims with costs in excess of 3 times the max, were significantly higher than the board average. So by pooling costly claims, they're going to benefit from that and see a 14-cent decrease in this element of the premium rate. And it's very similar to R11. There was no impact, R11. It's its own class, its own rate code. So there's zero effect by changing the way we pool pensions. However, they do have a slightly higher average cost of claims, average number of claims that are above the 252,000 or 3 times max. So they're going to benefit from pooling expensive claims. And the net decrease of that is going to be a penny, 1 cent. The next recommendation dealt with fatality costs. Under the current system, we calculate an average cost per fatality for all fatalities that occurred in the last 10 years. And every rate code gets charged the same amount whether or not you've had a fatality. The 2017 premium rates include a 4-cent charge for the average cost of fatalities for the past 10 years. Eckler said that's not very good accountability. What you should be doing is you should be holding rate codes that have fatalities more accountable for their own fatalities. Depending on the credibility of the rate code, we look at the average cost of fatalities over 5 years, and that's the case for all construction rate codes, because all of them would now be 100% credible. So what we'd be looking at is your average cost of fatalities over the last 5 years. The cost of a fatality can vary significantly. So when you look at some of the changes, and I'm going to tell you the number of fatalities in each rate code, you might scratch your head a little bit, but you got to remember, the cost of fatalities can vary significantly. If a single person with no dependents, the cost of that fatality might be $10,000, simply the cost of burial. However, the cost of a death of an individual who's married with several dependents may be as high as $1.6 million over the life of that claim. So in order to recognize the diversity in the costs of fatalities, the board said that we will cap fatality costs in the same way we cap every other claim. 3 times the maximum insurable, which is currently just under that $252,000. So the difference between the 5-year average of fatality costs for B11 and the 10-year average for fatality costs across the whole compensation system would see an increase of 2 cents in B11. B11 had 9 fatalities from 2011 to 2015. B12 had 12 fatalities from 2011 to 2015. And the difference, again, between the 5-year average for just your rate code compared to the 10-year average of the whole compensation system would see an increase of 4 cents in this area of their premium rate. B13 had 14 fatalities from 2011 to 2015. And again, the difference would be a 2-cent increase from 4 cents to 6 cents. So increasing this area of the premium rate by 2 cents, comparing your 5-year average of fatality costs compared to the board level 10-year average for fatality costs. An R11 would see a 2-cent increase for the same reasons. An R11 had 18 fatalities between 2011 and 2015. This is one of the changes that I think is probably easiest to understand in the new model. Long-term claims. So I mentioned earlier that we could pay claims for up to 50 years. And under the current model, I also mentioned that we calculate a 5-year average. And that 5-year average includes the costs of all claims paid in the 5-year period. So in any one of those 5 years, and for the 2017 premium rate, we're talking about 2011 to 2015, in any one of those years, we could have claims that are 20, 30, 40 years old and still have costs associated with it that go into that particular year. So under the current model, we don't care when the injury happened. If there is costs in that particular year, we're going to include it in calculating the 5-year average. The assumption being that in your industry, you're going to have similar injuries and costs that you had several years ago. Eckler said that's not necessarily true. Many of the employers have changed. So in fact, many don't exist. Industry practices and technology may have changed. And the experience of employers in your rate code many years ago do not necessarily reflect the experience of industry today. Eckler suggested we should use a shorter experience period, somewhere between 5 and 10 years. After our analysis, we determined that after 7 years, we would typically capture 75% of costs of a claim. So instead of going back 50 years, in every one of those 5 years, 2011, 12, 13, 14, 15, instead of going back 50 years of costs, we would only go back as far as 7 years. So in 2011, we include the costs of all claims that occurred in the previous 7 years. So we only go back 7 years and then just stop. We would do the same thing for 2012, 2013, 14, and 15. So when we established the premium rate for 2017, we looked at 2011 to 2015. Under the current model, we go back as far back as there are costs under any of those claims, where we see costs in any of those years, 11, 12, 13, 14, and 15. Under the enhanced model, had we implemented it, we'd only go back 7 years. So we're still going to have to pay for the remaining 43 years of costs. So what do we do with those costs? What the board has approved is that we would take the remaining costs in those 43 years and we would pool them, and based on claims experience, we would spread those costs proportionately across all 50 rate codes. So what's the potential impact of this change? So if the majority of your costs are in the most recent 7 years, by dropping the other 43 years in the calculation of the average, this is going to drive up your average premium rate. If the costs in those 43 years are greater than the costs in the most 7 recent, by dropping those 43 years, this will likely decrease your average premium rate. So let's look at the impact of this change to the model. So this particular change increases reactivity and accountability by simply putting emphasis on the most recent cost experience. If you're improving, you should see reductions in your premium rate. If you're not, you could see increases. So for B11, your portion of the 7 years of costs are higher than your portion of the 43 years of costs. So your premium rate will go up slightly by 1 cent because of this impact. In B12, your portion of the 43-year costs are actually higher than your portion of the 7 years. So that's going to cause, so your more recent experience is better, which is going to cause your premium rate to go down by 14 cents. In B13, again, the 43-year tail of costs are much higher than the portion of 43-year costs for the most recent 7 years. Which is going to cause your premium rate for this particular element to go down 30 cents. And a similar experience in R11. The portion of the 43 years of costs are much higher than the portion of 7 years of costs, which is going to drive down your premium rate by 13 cents in this particular element of the premium rate. The next recommendation has to do with the way we allocate administration costs. So our administration costs, like any other business, is divided into 2 categories, fixed and variable. For us, fixed costs are all the costs associated, so all the costs related to running the business that aren't claims related. That's probably the simplest way I can say it. So anybody who is not directly working on claims, all those costs are related to our fixed costs. IT, human resources, calculating premium rates, registering employers, all those basic costs would be considered our fixed costs. Our variable costs are all costs associated with those who work on claims. Under the current model, we've assumed that 10% of our costs are represent our fixed costs, and the remaining 90% represent our variable costs. The 10% fixed are allocated across all employers based on their percentage of payroll. The 90% variable are allocated across all employers proportionally based on their claims costs. Eckler said that this is a good approach, but make sure that the percentages are right, which caused us to undertake an analysis and actually divide all of our costs into the kind of the fixed and variable buckets. When we completed the analysis, we determined that our fixed costs actually represent 30% and our variable costs represent 70%. So we've adjusted the fixed component from 10 to 30 and the variable component from 90 to 70. And I can tell you when we looked at this, that's more in line with other jurisdictions. The 90-10 split was probably more of an outlier. I think Alberta's 75-25, Ontario's 50-50. So it's the 70-30 is more in line with what other jurisdictions would see. So what would be the impact of this change? For B11, you would see a net impact of $0.01. So what's happening? Your costs associated with claims related or the variable costs would go from roughly 35 cents down to 27 cents. So your claims related costs in the system, as it relates to the administration of those claims, would see a decrease from 35 to 27. And everyone's fixed will go from 3 cents to roughly 10 cents. The net impact of that is going from 37 cents down to 36 cents. B12, your variable costs will go from roughly 62 cents down to 49 cents. And like everyone else, fixed will go from 3 to 10. The net impact of that is going from 64 cents to 58 cents, which is a 6-cent decrease related to administration costs. For B13, the variable costs will go from 43 cents down to about 30. Fixed will go from 3 to 10 for a total of 46 down to about 40, which is a 6-cent decrease. And then R11 will go from roughly 40 cents related administration costs for handling claims down to about 28 cents. Fixed will go from 3 to 10. And the total impact of that is going from roughly 43 cents down to 38 cents. So when we put all this together and reconstruct the premium rate based on these changes, what we see for B11 is we'd go from $1.52 to $1.53. So had we implemented in 2017, your premium rate would have went from $1.57 in 2016 to $1.53 in 2017, which is about a 0.7% change to what you see today in 2017. The net effect of that is an increase of about $63,000 in claims cost, or in costs and premiums, I should say. There are roughly 2,000, a little over 1,900 employers in this rate code. So the average increase would be about $35 per employer in this rate code, had we implemented in 2017. For B12, the premium rate would have went from $264 to $257. So in 2016, you'd have been told your premium rate's going from $2.82 to $2.57. The net effect of that, of going from the current model to the enhanced model, would have been a decrease of about 7 cents. The net impact of that on the rate code would have been a decrease of over $466,000 in premiums. There are a little over 4,600 employers in this rate code. So the average decrease would have been about $100 per employer. For B13, the change in the model would have went from $1.97 down to $1.71, which is just over 13% change. The net premium impact of that change would have been a little over roughly $3.2 million less in premiums. There are roughly 2,900 employers in this rate code. The average decrease would have been about $1,100 per employer. And for R11, they would have went from $1.73 to $1.53, or they'd have had a premium rate of $1.53, going from $1.86 in 2016 down to $1.53 in 2017, had we implemented the enhanced model, which would have been about 11 or 12% decrease. The net premium impact of that change would have been just over $1.6 million less in premiums. There are roughly 2,600 employers in this rate code, so the average decrease would have been just over $600 per employer. So next steps. All the rate code educational sessions that we've been doing last week and again this week, that we'd done last week and we're doing this week, all being recorded as webinars. Those webinars are going to remain on our website so that you can go back, review it again. If there are people you know that just couldn't attend, they can go in and listen to the webinar at any time. As you review the information or go back and think on this information, you may have questions. If you have questions, we've set up an area that you can submit questions at askwcb@wcbsas.com. We're tracking all these questions so that if there are trends, we can try and get more information out to people. And also, one of the other reasons for doing this presentation was you can see that the impacts of these changes can be significant, both on the positive and negative side. Because at the end of the day, we're not requiring more premiums. We're not requiring less premiums. When we ran the enhanced model against the current model, the amount of premiums came out the same. But the distribution of those premiums has changed. And you can see if some rate codes are going down, some rate codes are going to go up. And we would like to hear from you on your ideas, suggestions for transitioning the impact of going from the current model to the enhanced model. So had we implemented, for example, the $3.2 million in B13, how do we transition that amount? And again, if we transition down, somebody's going to be transitioning up. We could rip the Band-Aid off and do it all in 1 year for some rate codes, for all rate codes. We could split the amount over 2 years. So again, if it was the $3.2 million, we'd take half of that in 2018, apply it, and half of it in 2019 and apply it. So it's just the amount. That amount is all we need. Whatever, and it's going to be different in 2018, but 2017 is a bit of a proxy for what 2018 might look like. But it's the amount that we need. It's a one-time amount that we need to transition from the current model to the enhanced model. And then after that transition amount is done, it's just simply experience of your rate code that takes over. So on our website, there's an area that you can provide your ideas or suggestions or feedback on transitioning at www.wcbsas.com/feedback. So there's a link on our website for feedback on the transition. We've put a couple of suggestions up there. Do it all at once, do it over a couple years, and then anything else that you can think of in terms of what might be a good idea or you think might be a good idea. And we'll be taking all of those suggestions and considering them and figuring out how do we transition from the current model to the new model in 2018, the enhanced model. And we are open to any ideas or suggestions that you may have. And finally, I would be remiss if I didn't say something about injury prevention. We all know, you know, the best solution to managing claims costs is just preventing the injury from happening in the first place. Our goal, our collective goal, and I know many of you, if not all of you, are big supporters of WorkSafe and Mission Zero. And I want to personally thank all of you for the efforts you've made in helping make Mission Zero a reality. In 2016, 88% of employers registered with WCB had 0 injuries. 0 time loss, 0 fatalities, 0 no time loss. It's phenomenal. And that number has been increasing from 85 to 86 to 87 to 88. So there's no question industry is making progress, and we appreciate it. But again, we all know we've got more work to do. So thank you. I appreciate for all those in attendance online and those that have braved the cold, blustery weather here in Saskatoon today. Thank you for attending. And I'd now like to open it up to any questions that you might have. And if you have questions, if you could use, Steve's leading the way, use the mic because this is being recorded, and then we can, people can hear your questions if they listen to the webinar later on. Steve?
Okay. Is the mic on? So what I wanted to ask you, Phil, it's Steve Walls, Heavy Construction Safety Association. When you're talking about the fatals, you know, at one time it was 4 cents across everybody. Now it's going to be at the rate code level, except now what's happened is you are actually going to cap it at $252,000, and then the remainder would go to the actual costly claims pool, then spread back out over the whole. Is that?
Yep, you got her.
Okay.
Bang on. All claims will be capped right now at 200, well, in 2018, all claims, regardless of type, would be capped at $252,000. Any amount above that gets pooled at the board level and then reallocated to each rate code based on their proportion of claims costs in the system. So you're going to get, if you have high claims costs, you're going to get a good portion of that back. But the idea being is for those really expensive claims, no one particular rate code or employer is overburdened by that. And I did ask our data governance group to do some analysis, like how many claims would be over $252,000, and it's less than 1%. So they are pretty rare events.
Hi, thank you for that today. I've talked with a number of employers over the last few years. We talk a lot about the employer accountability and setting the rates and how that transpires. Has the WCB addressed worker or employee accountability in helping to set the rates? As an employer, sometimes we can only do so much in terms of incentive and programs and policies, and you can't stand beside everybody every day. We see often in fall time a lot of deliberacy in maybe getting onto the programs. You know, we've all heard, well, it doesn't matter, workers' comp pays more than EI. You know, if we could find a way that would help in eliminating some of that willful disobedience on that. We've discussed over the years with workers' comp and some of the safety organizations about even creating a financial driver that may potentially reduce, even by a tad, some of these contributions to a worker that willfully disobeys safety programs and policies and procedures. Has the workers' comp addressed any of that in the last few years going forward?
Couple points to that. So there's 3 points I want to address in that. One is there's a provision in the legislation around if somebody intentionally does something. Now, somebody not wearing their hard hat doesn't necessarily mean they're intentionally trying to hurt themselves. But the second piece of that is if we start thinking about, you know, who's more accountable in what situation, remember that historic compromise at the beginning that I talked about? We start to break down that historic compromise. Because if we start to want to talk about degrees of accountability, then workers may want to talk about degrees of accountability and maybe prefer to sue an employer versus collect the premium that, or the benefit that they're getting. And we do. We have injured workers who truly believe based on their injury and the acts or lack of acts by the employer in certain situations that they should have the right to sue. So that conversation would actually probably end up having to go both ways. And that starts to break down the basis of which the workers' compensation was built on. So I don't discount at all kind of what you're saying, but you also have to go back to kind of that historic compromise. The third point I want to make is recognizing, and I think, you know, it's trying to get people to follow the training and the rules. It is no question a challenge. It's a cultural challenge in industries and employers. But I can tell you some employers have figured it out. Some employers have less of a challenge around culturally whether or not their workers are going to follow the rules and the programs and the training every day. I'm not saying it's perfect. I don't think any employer has it figured out perfectly. But it's beyond just the training and the rules. It's culturally how that workplace as a whole sees injury prevention and what value they place on it, beyond even just the priority of it. What's their value? Are they willing to take that risk if nobody's watching? And that's a challenge. There's no questions it's a challenge and it's not easy, but that's really, I think, the next piece of the puzzle for us collectively on the injury prevention front is how to change cultures within a workplace and helping employers and workers change that culture so that it's not a babysitting exercise. It's just the way people want to do the work. Good question, but it's not an easy answer.
Hi, Phil.
Hi.
Is this on?
Hi, Ann.
Is it on? Could you hear me?
I can hear you, but I don't.
It's on? Okay. I have a few questions from online. So if benefits end at age 65, is there any plan to stop collecting premiums for employees who are over the age of 65?
No, because if a worker is over the age of 65 and is injured, there are still some benefits that get paid. There could be a cap, a limit on the length of time they get those benefits, but there'd still be medical, there's other things that would costs that would be incurred related to that older worker being injured.
Thank you. I have another question from Yvonne from Riverbend Developments Ltd. We are currently B12. Would we lose our discount rate on the new model?
Good question. The experience rating program is not going to change right now. So any discount that you would have would not necessarily change. We're still going to calculate that in the same way.
I'll just keep going unless somebody else gets up to the mic. I've got a few more here. So this question is from Mark Cooper, Saskatchewan Construction Association. Hi, sorry I can't be there in person today. Good presentation, thanks to Phil. Based on trends over the last 5 to 10 years, what do you anticipate will the impact on B11 to 13 and R11 codes over the next 5 years, all things being equal? And then the second part is what codes are hardest hit by the increase, and when will the transition decision be made?
Oh, good question. I forgot to mention that about the transition period. So we will be taking feedback on the transition up to April 7th. So if you've got feedback related to the transition, if you can get it to us on or before April 7th, that would be great. We'll take all that information and we should be determining, I don't know the timeline after April 7th, but we'll get the feedback and then we'll be looking at all the options in terms of transitioning. But obviously we'd need, 2018 premium rates are coming out into the fall, so we'd need to know what that would be going into kind of the, as we start to publish the 2018 premium rates. The 5-year trend, good question, Mark. I mean, if you look at the previous 5-year trend, most industries are going down in terms of injuries and premium rates, but it's hard to predict. I mean, experience can change pretty fast. If you drop off a good year like 2012 and pick up maybe 2016 is not a great year, that experience can change pretty quickly. So there are other factors in terms of, you know, how industry is doing in terms of growth, the amount of payroll in there. There's a number of factors. So I guess I'm dodging your question, Mark, because it's really hard to predict it's hard to predict sometimes what a year or two looks like, let alone 5 years from now.
And then he did ask one further question there. What codes will receive the hardest increase?
You know, I don't remember those offhand. Do you remember, Ann?
No, but I don't think we've had those presentations, so I don't think it would be fair to
Okay.
talk about that just yet.
I know I reviewed a couple where there's some, and they're coming in the next couple days that are some pretty good increases. I've done one in oil and gas that saw a pretty good increase of, I think, over 10 or 15 cents. So.
Why are some companies allowed more than one rate code and others limited to one code? We are not allowed to have two codes, even though we have two distinct labor forces in one of our companies. So a classification question.
It depends on kind of the primary activity of the business. If a business could stand on its own, so in some cases, the common question we get is related to the administration side of a business. Many employers would like us to split off the construction and administrative side into two different rate codes. But in many cases, and in almost all cases, the administration wouldn't stand on its own without the construction side of the business. So the primary activity is construction. If your business has two unique entities that could stand on their own, you may want to ask us about potentially having two rate codes. The other piece is how big is that second portion of your business? In some cases, it's such a small part that it doesn't really benefit the employer to split it off.
Okay. Are there any other questions from the floor here? Because I do have a few more, but I guess I'll keep asking until somebody else gets up. Okay, this is from Westbridge Construction. Will company experience rates correlate with the new rate model? For example, if a company is in a discount now, would they still receive a similar discount under the new rate model?
That's a good question with the capping, the $252,000 capping. That may change a little bit. Some of your cost experience may change with the different capping of $252,000 versus just the $90,000 capping on pension. But for the most part, it should be very similar.
Okay. And this question is from PCL Construction. Can you advise if the same enhanced model analysis was performed on 2016, 2015, 2014, et cetera, to identify what the industry rate codes would have been? And are the rate code differences in your 2017 analysis similar to those years?
No, we didn't go back that far. This analysis was more for educational purposes. The rate model changes itself are based on kind of sound scientific principles of how to balance those four principles of accountability, collective liability, fairness, as well as reactivity and stability. So the model, the enhanced model was really based on looking at how to best balance those four principles in all fairness to employers, the rate codes, the system as a whole. So we didn't go back and do the calculation and try and figure out which changes to make and why. We actually created the model first and then ran the 2017 numbers to see the comparison of what it might look like going forward. Because the model, we truly believe the model, the enhanced model is the right model for the system and for employers. Beyond that, no. Yeah, we didn't go back and recalculate those numbers. I'm not sure the benefit of that would have been simply because we're certain the new model is a better model.
I have another question here from the Saskatchewan Construction Association. Phil, thanks for answering the questions. How is it anticipated that these changes will impact rate volatility?
It will, other than the transition year, which could cause obviously some ups and downs, some adjustments in terms of what rate codes pay what, it really creates a more stable environment, but at the same time holding rate codes more accountable. So it becomes a bit more reactive in a way that you're more accountable for your industry's experience, but the way we're pooling things should create a bit more stability for rate codes overall.
The last couple of years, we've seen a few refund checks come on account of some of the extra excess in the WCB. With the new analysis and development of the new rates, have you changed some of your investment models as well? Do you expect any of these new checks to come back, or do you expect these new rates set to be essentially what it's going to be? I guess in essence then, in general, raising our rates in the B and R codes, correct? Because we've had such big refunds that the difference in what we've paid the last couple of years might potentially be quite a bit less than we're going to be paying in the next few years with the new rate development.
So the refund checks and the rate model itself really are not connected at a basic level. The refund checks were related to excess earnings of investment. So in the presentation we talked about, we collect a certain amount of money. So we predict the costs of the 2017 injuries. We collect that amount of premium, but the majority of that premium we invest. And we expect a certain rate of return on that money that's invested. The rebates are simply because our investment returns were higher than we had planned or expected them to be. That's what those so what we predict going forward, the rate model simply predicts the amount of money that we would need, again, the idea being no more, no less, to pay for the costs. The rebates that have been sent out are only related to the fact that we've had, our investments have outperformed our expectations of what we had originally planned in the model.
Phil, just a question asking about getting the input as to how people would like to see it proceed. Now, would it be possible, like, let's say the R code says, oh, geez, we want it to all take place right away. Somebody else says no. It's probably not going to be rate code by rate code. It's probably going to be based on if the majority say rip it off, it's done in 1 year. If the majority say 2 years, is that what you guys are looking at?
I'm pretty sure that's the way we'd kind of have to look at. I mean, we may, I don't know, we could potentially say, look, if it's less than this amount, we're going to rip off the Band-Aid. If it's over this amount, we'll balance it out. Like, we need to balance it out so it's zero at the end of the day. We need to, if we're handing some out on one side, we got to kind of take it in on the other. So somehow it's got to balance out at the end of the day.
Hi. I was just wondering, like your B12 and B13, how do you categorize companies in these different, I'm a journeyman electrician, I'm a sole proprietor, I work in both industries, but my rate is at a higher rate because they got me in B12, residential construction, instead of industrial commercial, and I work in both areas equally. Is there any way of getting some sort of a flexibility thing, or what?
Well, what we would do is look at it. So you could end up in any one of 3 rate codes. 11 are certain trades. 12 is if you're working primarily in residential construction. And 13 is if you're primarily working in commercial or industrial construction. So, you know, we could work with you to look at where most of your work is being done and potentially decide, analyze it and see if you belong in a different rate code. And that happens. Sometimes people start in residential and end up more in commercial or industrial, and vice versa. So,
yeah. One other thing too, because a sole proprietor, I'm not required to have WCB, but I have it because when I work for other companies, they don't have to blanket me.
right.
Okay. Now, is there a way of, like, because the letter I just got in the mail is that, okay, you can pay premiums for whatever you want, but if your income is down here, that's all we're paying you out for, even though your premiums were being paid for up here.
Yeah, that's a good point. And we need to make sure it's very clear to you that if that the amount that we'd pay out to a sole proprietor is capped. So you shouldn't be paying any more premiums than that amount.
Oh,
If it is, we should adjust it for you.
okay, so basically I just have to phone down there and find out a set. Well, is there like a minimal I can pay? Be like, say, basically say, okay, I have my own disability insurance. I show that to workman's compensation, so I can be kind of, okay, you don't need this extra insurance, you just need to be notified that you have coverage, I guess, I don't know.
Sole proprietor, we would just need to see that whatever you've elected for your amount of coverage, there's that amount, at least as it relates to your T4. So we could work with you to figure out if you want to pay the least amount possible, we can work with you to figure out what that would be under our policies and legislation.
Okay, thank you.
Yeah, but it's a good point. There's an actual glitch in the way we communicate, and we've had to go back to a few sole proprietors and say, you've overpaid us, because we're not going to pay out that amount to you. Yeah, it's a good point.
Okay. Yeah, thank you.
This is a question from Brian. How do the rates affect new companies?
It'll be the same for new companies. They will come in on the base premium rate. So you get the base premium rate, and then your experience over the next 3 years will start to dictate whether you're going to go up or down based on experience rating.
Okay. And I have one more question. Will there be any changes to the standard enhanced experience rating model at the company level?
So some changes to the experience rating program were implemented this year. There's a few changes. One of them on the standard program was that what we would have considered a time loss claim. So if the only reason a worker misses work is to attend a medical appointment. So through the life of the claim, if the only reason the worker misses work was to attend a medical appointment, that would now be considered a no time loss claim. From a cost-based perspective, doesn't really change anything, but from a definition perspective, especially for a small employer where you're counting the number of time loss claims that impact your surcharge or your discounts, that is going to impact a few hundred employers. So again, I want to kind of reiterate, if the individual is injured, goes back to work, and the only reason that individual misses work is to attend a medical appointment, that would now be considered a no time loss claim in our system. That's one of the bigger changes. The other change that we had is we used to cap the difference between standard program and advanced program was $15,000 worth of premiums. That's now $21,000. So more employers are staying in the standard program because we've increased the amount of premiums required to go into the advanced program. That's a benefit for most employers. Most small employers that jump from the standard program to the advanced program, there's a few that get kind of caught with some pretty big increases, like 10% sometimes. So we've capped that as well. If an employer is transitioning from the standard program to the advanced program, and you're in a discount situation, a no discount or discount situation, you'll carry that forward until your experience starts to change. So the board made 3 pretty significant changes to the program that will benefit some employers.
This isn't so much a question, it is maybe an unfavorable statement or two. There are some employees who have misused the system based on a comment made earlier. One recent situation we have come across is the employees are aware that they are no longer allowed to sue or as a part of this process because they are taken care of well, which is a good thing, and it is a good system. However, we have found that they are now seeking mediation by means of seeking additional financial gain if they have been declined by workers' compensation for matters of not providing a cause of an injury during work. Second of all, if the model is based on accountability and collective liability, will that be looked at when administration considers employee accountability and collective liability, as some employees tend to cross employers over a 7-year period where they have received compensation benefits from one company and then move to another company, and although they are in the same rate code, I'm hoping that administration will consider the employee accountability as a part of the entry into the system.
So I'm not sure what you mean by employee accountability.
As the employers will now be considered over a 7-year period for their claims costs, the majority of the Canadian workforce are very hardworking individuals. They come to work every day. They want to make society better. They want to make themselves better and their families better. However, there are some individuals who don't share that same goal of the greater good and have repeat claims in one company, then move to a second company and have a second claim, and then move to a third company and have a second claim or a third claim. As it is an insurance-based system, there is no will those employees be held accountable internally? That is the question.
I see what you're saying. So the short answer to that would be no. In particular because those 3 injuries could be bad luck for the worker too, in terms of that worker could be put into 3 difficult spots. As much as I would say the overwhelming majority of employers really do care about their workers and are trying hard to make sure that their workers are safe, that's not all employers still today. And it could just be that that individual was put in 3 difficult situations. I'm not discounting what you're saying at all, but it is a no-fault system. As much as employers can be just as negligent as workers. And workers are not allowed to sue employers even if the worker's been put in a difficult spot by the employer. So again, that road would have to go both ways. If there are workers who potentially take advantage of the system, and as much as this might be hard to believe, there are also employers. Pardon me? So the question is that employers have a punishment system through H&S, a mechanism where, yeah.
Through the willful, neglect to safety of employees, employers do have punishment mechanisms in place. Even if there's no suing, you'll stop being able to get jobs. Owners won't even take your bids. There's detriments for employers not buying into safety.
Right.
There's really not much at the moment for employees not buying into safety.
So I could list you 6 employers that have let long-term employees go, good long-term, what they would consider good long-term employees, because they won't follow corporate rules around safety. And it's difficult situations, and if you've had a chance to go to the leadership chart, health and safety leadership chart of the last couple of years, you would have heard some employers talking about that. They have 0 tolerance. And that's the way their staff understands that the employer is serious about this. So in some respects, there is a bit of an accountability mechanism at the employer level for workers who choose not to follow the training and the rules that the employers put in place. The employer report of injury. Oh, sorry, yeah. Yeah, I mean, that's the other side of it, is if a worker submits a claim and the employer doesn't believe that injury is work-related or is attributed to the work within, could be associated with an old injury from another employer, you can and you should let us know that you don't believe it's work-related or you don't believe that it's related to the work that they've done for you. It could be associated, just an old injury that they're applying for. They do that on the employer report. There's a question there that you can clearly state that you don't believe the injury is work-related, or that you have issues with it being a work-related injury, or just issues with the claim in general. And then you can talk to our case managers or our claims folks and start talking to them about some of the issues that you might see. And we can potentially follow up and try and gather the right information to determine whether or not it is a work-related injury. At the end of the day, if there's disagreement at that level, you can always appeal. And there's an appeal body within the administration and an appeal body at the board level. And I can tell you, in both cases, for both workers and employers, those decisions do get overturned.
I have another question from online, and this is, will the capped claims costs, the $90,000 increase to $252,000, affect the individual company's experienced rating calculation now?
Not really, because we have capped costs at the maximum insurable already. So if you look at your employer reporting, and I can't remember the C11, I can't remember which report it is, but there's reports that you can get from us, and it'll show you your total costs and your capped costs. We already cap costs at the maximum insurable in terms of calculating the cost that you're responsible for as an employer. Any other questions online? All right, if there's no other questions, I would like to thank everyone online and everyone in attendance here for A, showing up to the presentation and putting up with me this morning, and B, asking all these great questions. We really appreciate it. Thank you very much, and have a safe, warm day. Yeah, thanks for that. Thanks. Thanks. I wasn't even thinking about the...
What are you trying to do? Oh, you're putting down just some slides together.
Yes, and I'm all proud of myself.